This week, the US stock market has been on edge as a series of critical economic reports unfolded, starting with the economic calendar of June 1st till 7th, which flagged major events like ADP non-farm employment change on June 4th and the non-farm employment change on Friday. On Wednesday, the ADP report delivered a stark warning, revealing the weakest hiring in 2 years with only 37,000 jobs added in May, well below the forecasted 111,000 as companies paused hiring amid escalating trade wars. However, the non-farm employment change report on Friday brought a slight reprieve, showing 139,000 new jobs added in May, above the expected 125,000, while the unemployment rate held steady at 4.2%. Markets breathed a cautious sigh of relief, with analysts noting they were happy it's not worse, though concerns about economic slowdown and trade tensions continue to loom. We're going to talk about macro and then dive into the technicals to see where we currently are in the markets. So this video is packed today, tons to dive into. I'm Danny, by the way. Welcome to the channel and let's get started. Alright, so let's start with the job market. We all know that's a major factor in the economy. So this chart shows the latest ADP job growth numbers for May 2025, and we're seeing just 37,000 new jobs added, which is the second lowest since March 2023 and way below the 114,000 that analysts had expected. So you can see the drop on this graph and it's pretty steep. Sectors like education, health, and professional services, they're losing steam, while manufacturing and mining are actually losing jobs. So ADP's chief economist Nella Richardson said hiring is slowing down after a strong start. So the job market isn't looking too hot right now, but what about layoffs? Let's check that out next. We have two graphs. The first one shows initial jobless claims across the US, and they're staying pretty low, around 220,000, despite some holiday ups and downs. So that's a good sign of a steady labor market. And the second graph shows federal employee claims, which ticked up a bit during the same week, but they're still way below their peak from February 2024. The report also says government jobs are expected to add 10,000 positions, and federal layoffs haven't been a big issue, even with a hiring freeze. So the job market seems stable, but there's more to the story when it comes to the stock market. So let's move on and see how investors are behaving. So this one tracks margin debt, which is money investors borrow to buy stocks. Back in January 2025, it hit 937 billion, but then it dropped by 90 billion over 3 months to 851 billion by April. So that's a big decline, and usually margin debt typically peaks when this market is super speculative, so this drop doesn't really match that pattern. So this chart also says that a 20% S&P 500 gain would match a 90 billion decline in margin debt, which is what we're seeing here. And so investors are a little bit cautious, and that could mean the stock market isn't really as overheated as it might seem. But what's keeping the market steady then? So let's take a look at the next one. Here we have a chart from Nomura showing that corporate buybacks are playing a big role in 2025, and S&P 500 companies have authorized 717 billion in share repurchasing so far this year. That's a lot of money. The chart shows this number has been growing since 2018, and the thing about buybacks is that it acts like a shock absorber for the market, keeping things stable. The second part of the chart shows global equity flows, and we can see investors are now overweight the US compared to Europe and or China. This shift is helping the US market stay strong even with some global challenges. So buybacks are a big support, but how's the S&P 500 actually performing? This chart shows S&P 500 revenues per share, both actual and forecasted from 2012 to 2026. You can see the actual numbers in blue and forecasts in red. Revenues have been climbing steadily, and analysts are bullish and expect them to keep rising into 2026, hitting record highs. The chart says that in Q1 2025, revenue per share were 1,887, and they're expected to grow at a good pace. This is a strong sign that the S&P 500 companies are doing well, even with a slowing job market. But what about their earnings? That's coming next. Here we're looking at S&P 500 earnings per share, or EPS, forecast for 2025 and 2026. The blue line is the S&P 500 index price, which is at around 5,900 as of June 2nd, 2025. The orange line is the EPS estimate, which dropped to 263 for 2025 and 295 for 2026. The chart points to something key. For the first time this year, EPS estimates for 2025 were revised slightly higher last week. That's a sign that earnings might be stabilizing, which is great news for the market. markets. But what's driving these market trends? Some people think it's all about bond yields. Let's see if that's true. So this analysis examines the correlation between the 10-year Treasury yield and the S&P 500 returns since 1940. The yields are categorized into ranges such as 0 to 2%, 2 to 3%, and so on. And here's a surprising revelation. The S&P's median annual return remains remarkably consistent across all these yield ranges, averaging around 15 to 19%, except during periods of exceptionally low or high yields. In essence, yields don't significantly influence stock returns. Inflation emerges as a more crucial factor. Therefore, while yields contribute to the picture, they don't encapsulate the entire narrative. So let's dive into another aspect of the puzzle, the US dollar. This chart shows that investors are betting against the US dollar at the highest level since 2023. The black line tracks the total short positions on the dollar against 10 other currencies and is close to a 40 billion net short position. The chart says this signals a big trend, taking the dollar lower and making yield curves steeper. That could mean lower interest rates in the future, which might boost the economy and stocks, but it also affects other markets, like commodities. So let's see how it's playing out with gold and silver. Here we have a ratio of silver to gold prices compared to its long-term average going back to 1982. The blue line is the silver to gold ratio, and you can see it's breaking out. It's above its long-term average for the first time in a while. The chart says silver is now looking cheap compared to gold, which could be a great opportunity for investors. Silver's breakout is a big deal in the commodity space. And speaking of metals, let's wrap up with a big policy change affecting the steel industry. Here's the big news. On June 4th, the White House raised tariffs on imported steel and aluminium from 25 to 50%, citing national security. The chart breaks it down. The UK gets a break until July 2025, but other allies are being pushed to finalize trade deal fast. US steel prices are up 25% this year, while China's down 8%, which is boosting US steel companies like those in the Dow Jones Steel Index. But there's a ripple effect. Countries like Mexico and Canada might face economic risk, and US firms will deal with more complex trade rules. The graph shows US steel production rebounding sharply in 2025, which might be an early sign of the tariffs' impact. So these tariffs are shaking things up in a big way. Switching over to TradingView, let's take a look at the S&P 500. Right in front of us, we do have the SPY on a weekly chart. And as we can see here, we have still a gap above this level here, and we are broken out to new highs here. So the S&P is looking very constructive here, very in line with what we talked about with the macro, and we can see here that this breakout here set the stage now for new higher highs. And we're watching some of these key levels here, but specifically this failed auction, we mentioned this previous times as well. So it looks like the S&P wants to retest this auction level, and then perhaps we could get a bigger pullback, correcting this entire move. We are, however, very bullish long term, but we do believe eventually some of these key moving averages will be tested. And if you move forward here, take a look at the QQQs. The Qs are not far from breaking new all-time highs as well. However, we are still below the session from yesterday, so the Qs have not broken out to new highs. Only the SPY have done so far. Let's also take a look at the Russell 2000. This breakout here was very anticipated. We looked at this and said, well, this retest here of the 55 was gonna initiate a new breakout. So we are officially now above these, or this trend line here, and we're looking for this value area high here as a potential target. And we believe that this level is still not yet completed, because this is part of an impulse here. So we could get a retest of some of these moving averages. Maybe the 233 looks like a good potential candidate here if we were to get a pullback and start a new impulse from there. However, the Russell 2000 looks very constructive here, and we also remain bullish here on the Dow Jones Industrial Average. Let's move on and take a look at the 10-year Treasury yield. We've seen a huge bid here for the 10-year, although one can take a look at this and say this could be an impulse here towards the downside. Maybe we're doing a sucker rally type of a situation before resuming lower. So this POC line here will be closely watched, because this is typically a level when you break down from it, you want to retest it before resuming lower. However, long term, we do remain very bearish here on the yield, especially the 10 years. So eventually we do believe that we are going to see continued downward trend for the 10-year. Moving forward here, let's take a look at the 2-year. Same thing here. We're seeing a massive bid here towards the upside, maybe a test here of the 233. before resuming lower. The 2-year is almost approaching that 4% level, while the 10-year is at 4.5%. Silver broke out here. We mentioned silver when we drew this trend line here, and we had a potential cup and handle situation. Those who took the trade, congratulations. You are up significantly when we highlighted this in our previous videos. And so we believe that silver is now in a massive bull market, and to participate in this potential gains moving forward, you could also take advantage of some of these silver junior companies. We like these ones because they have smaller market capitalization and they tend to be much more volatile than the silver counterpart. We're looking at miners here. That's basically what I'm showing here. So if you're investing in silver and if you know that silver is going up, obviously you do want to participate in the miner space as well. Just as I also invest in Bitcoin and crypto, I also love to take a look at the miners as well. We're going to do a deep dive on that in a video in the future. Let's also take a look at the US dollar here. And as we can see, I showed you previously that we got a retest of the 10-year of that POC line, and it looks like the US dollar wants to do the same. So we're going to see here if the dollar is actually going to catch a massive bid above these key moving averages, or if this correction is now over and that we will just proceed much lower. From here, we can see that we have not yet broken to new lows, and watching the dollar here will be very, very critical. Let's also glance a little bit quickly here, looking at gold. Gold is not participating here. In the previous charts, we looked at the silver to gold ratio, and this explains it very, very handedly. So we are seeing a potential retest here of trend line, so we could perhaps see gold starting to pick up some steam soon. So we're watching this 21 EMA and this POC level. If we start to break down from this moving average, I do believe that we're going to continue to see new lows for gold before establishing support at a lower level and then resume higher. Let's also take a look at the VIX. And I have to admit, I thought the VIX would catch a bid here, but since the markets are just powering higher, the VIX continues to fall below these moving averages. And so now that we are officially below that 233 EMA on a daily, it sets the stage for new lows here for the VIX. So we're watching this open gap here, this auction here. So maybe this could act as a magnet, and then we'll see if there's more volatility in the options market from there on. But we have not made new lows here, so we're watching the VIX closely as well. But any new lows for the VIX will obviously, reduce volatility in the markets, and there's just more upside for the major indices moving forward. Overall, that's how the markets are looking at right now, and we remain obviously bullish here after that breakout here for SPY. We're looking for potential level here, maybe at around, let's see where this auction failed, around 610, and then we believe that we're going to start seeing some selling. So the catalyst could be the inflation report coming next week. I believe that's going to be on Wednesday, so that could be a catalyst for the markets to maybe take a breather, maybe retest some of these moving averages. So if you take a look at this one again, we have essentially just being above this 8 EMA all the time, right? We got to retest once here on the 21. So I'm looking specifically at maybe this 55, maybe, close this gap here. That would be very, very significant. Although this gap was almost closed here, so maybe intraday this one was closed. But either way, we're looking for the 55 here to perhaps getting retested. So that was basically it for this video, and I'll keep you guys updated. You can also follow me on X. I provide very, very good insights there, stocks that I buy, stocks that I watch, and so on. So I'll see you guys in the next video. Thank you so much for watching, and have a great weekend.